All right, let's dive in. This is one of those weeks where it feels like the entire global market is just holding its breath. Everything's in a state of suspended animation, and it really all comes down to a single economic report. One number that could totally force the hand of the world's most powerful central bank and, potentially unleash a huge wave of volatility across pretty much every asset class. So, let's break down exactly what's going on and why this one report has the entire financial world on edge.
And that leads us to the real question hanging over everything. The U.S. Federal Reserve, well, it's supposed to be independent, right? Driven only by the economic data. But the market is starting to seriously wonder if its decisions are now being swayed by some pretty intense political pressure. And this isn't just some academic debate. It's a real test of the institution's credibility. So what's causing all this tension? Well, the Fed is caught in this massive tug of war between the story it's trying to tell and the story the data is telling. It's signaling one thing while some of the most important economic indicators are basically screaming the exact opposite. I mean, just look at the contrast here. It's pretty stark. On one side, the Fed is clearly, and I mean clearly, paving the way for a rate cut. They're pointing to a shockingly weak July jobs report. They're downgrading their own assessment of the economy. And you've even got two Fed governors breaking ranks, demanding a cut right now. But on the other side, the actual data is strong. Second quarter GDP growth was just revised up to a really healthy 3.3%. Their favorite inflation gauge is still stubbornly high at 2.9%. And the markets where companies borrow money, they're showing zero signs of stress. So the big question is, which data set is the Fed actually listening to?
And this is where the market gets really suspicious. See, when the Fed seems to be focusing exclusively on that one piece of weak data, the labor market, while kind of ignoring strong growth and sticky inflation, well, traders start to believe that data dependency has become a cover for political dependency. They see a central bank that looks like it's searching for any excuse to cut rates, maybe to appease political folks who want to prioritize growth over fighting inflation. So this whole situation sets the stage for a massive showdown. The upcoming Non-Farm Payrolls report, or NFP as we call it, is way more than just another data point now. It has become the single catalyst that is going to force the Fed to finally show its hand. Now, for anyone who's not familiar, the NFP report is a huge monthly measure of U.S. job creation. But right now, it has taken on this outsized importance because the Fed has basically staked its entire argument for a rate cut on the idea of a weakening labor market. So this Friday's number, it's not just data anymore. It's a litmus test for the Fed's true intentions. So let's just break down the two ways this could go. If we get a hot NFP, let's say over 150,000 jobs were added, the Fed's argument for a cut just evaporates. Poof. Bond yields would probably spike, which would be really painful for tech stocks. Making a bet against the NASDAQ? A pretty viable idea. But if we get a cold NFP, something below 80,000 jobs, well, it's green lights everywhere. A rate cut is all but guaranteed, bond yields would fall, and you'd likely see a broad rally in the S&P 500. Two completely opposite scenarios, and it all hinges on a single number. With the stakes this high, you can bet traders are watching some very specific price levels like hawks. These are the lines in the sand that are going to tell us if the bigger picture, the broader trends, are starting to break down. There are three numbers that are on pretty much every trader's screen right now. For the S&P 500, that 6350 level has acted as a critical floor. A break below it could signal the rally's over. In the oil market, $63.63 is the technical battleground where fears of a slowing economy are clashing with all these geopolitical threats. And for Bitcoin, which often reacts to major economic news, holding the $106,000 support level is absolutely essential to keep its bullish momentum going. Okay, so while all eyes are on the Fed, there's a much bigger structural shift happening in the background. Geopolitical fault lines are getting deeper, and they're creating a new world order that's adding this really complex layer of risk to, well, everything. And this chart, it shows you exactly what's happening. While Western nations were busy sanctioning Russia, a new Eurasian economic axis has really solidified. Just look at this. Chinese exports of transportation equipment to Russia have surged by nearly 500% since the start of the conflict in Ukraine. This isn't just, trade being rerouted. This is the tangible formation of a whole new economic bloc that is actively building out its own infrastructure to operate outside the Western-led system. This geopolitical tension is having very real market effects right now, especially in energy. The escalating conflict between Iran and Israel has created what some analysts are calling a geopolitical put option under the price of oil. What that means is,
Even though the supply and demand data for crude oil looks pretty bearish, the risk of a sudden escalation that could disrupt supply is so high that it's literally preventing prices from falling. It's putting a floor under the market.
But here's the kicker. Despite that geopolitical risk, speculative traders are overwhelmingly betting that oil prices are going to drop. This chart just shows you how extreme that positioning is. Net short positions are in the 97th percentile of the last 5 years. That means almost everyone is crowded onto one side of the boat. And that creates a dangerously combustible situation. If any kind of bullish news pops up, it could trigger a violent short squeeze rally, as all those traders are forced to buy back their positions at once.
Okay, so let's tie all of this together. We've got a central bank at a crossroads, a single data point that could tip the scales either way, and this really volatile geopolitical backdrop that's just simmering with risk. What does it all mean?
The single clearest takeaway from all this is simple. The smart bet isn't on which way the market will go, but on the fact that it is going to move. A lot. This tension between the dovish hopes and the hawkish data, it has to resolve itself. And when it does, it's probably going to be explosive. The highest conviction trade isn't up or down, it's for a massive expansion in volatility.
So, here we are. We've truly reached an inflection point. The speculation, the positioning, all that's done. This week, the data will render its verdict, and the market is going to be forced to react. So the final question is a simple one. Are you prepared for the fireworks?